Well, I'm delighted to be recording a case study today with INHOUS and some special guests. And before I introduce the case study that we're going to look at today, I'm just going to speak with each of our panelists so that they can introduce themselves and describe the type of clients that they work with. So starting with David Johnson from INHOUS. Welcome, David. It'd be great to hear a little bit more about yourself and INHOUS.
Yeah, so we offer an independent buying and managed sales service to high net worth individuals, primarily covering prime central London.
Okay, great. Angus?
I'm a director of private clients at INHOUS, working on both sides of the business, so assisting with high net worth clients to purchase property and manage the sale of their assets in London.
Terrific. Shamonie, welcome.
Hi, I'm Shamonie from Barclays Private Bank, London. I look after global Indian families, high net worth and ultra high net worth families across the globe.
Great. And we're also joined by Hetal Sanghvi, partner at Edwin Co in London. Welcome, Hetal.
Hi everyone, I'm Hetal Sanghvi, tax partner at Edwin Co. I specialise in looking after global NRI families, in particular thinking about relocation to the UK, such as the family that we're going to be looking at today, but also matters of succession and asset protection.
So with our speakers introduced, I'm now going to introduce the case study that we're going to look at today, which is the case of Mr. Sharma. So Mr. Sharma is aged 48. He's married with 3 children aged 17, 14 and 11. He runs a successful retail business across India. He relocated to Dubai 3 years ago to build his business in the UAE and internationally from his new HQ. His daughter is applying to universities in London to start a degree course in September 2022, and she would like to have the option of staying in London after graduation in 2025 to pursue a career in finance. Mr. Sharma would like to purchase a property with a budget of £3 to £5 million in London, where the family can stay during the summer and throughout the year when visiting his daughter or on business. He doesn't mind which part of London, but many friends and contacts have properties in St John's Wood. So just starting off there, looking at the property search element. So Angus, if you were meeting or speaking to Mr. Sharma, where might he start with this kind of brief?
There are some specifics around it, but I think from our point of view, when we initially are just speaking with a client and discussing their property search, there's quite an educational aspect around it. So there may be £3 to £5 million is quite a wide range budget, in terms of a budget. There's a lot of different types and styles of properties that you can get for that, and there's also lots of areas that would cover that budget, even in and around St John's Wood and the surrounding areas. So it would be very much getting to know Mr. Sharma, his family, which universities his daughter's applying to, what commute time does she want for university, when they're in London, what do they enjoy doing? Do they enjoy going to the West End to theatre shows or whatever it might be? So very much working around them initially and getting to know more about the family. And then from there, we can drill down exactly what they were looking for in terms of the property. So, for that budget, you can get a detached or semi-detached house with a garden, or you can get a lateral 4-bedroom flat more centrally. So we need to work through that as well. It would then be educational around the areas from there. So it might be that St John's Wood actually doesn't fit the bill in terms of how they live their life or what they're looking to get from their property in the years to come. So it would then be making sure that we were looking in the right areas and narrowing it down from there.
And then do you take it to sort of road by road once you've kind of narrowed it down into some postcodes from the global search, as you say, you start with a fairly blank canvas? Is that where it ends up, looking at very niche areas?
Absolutely.
Yeah.
We're at the moment we're finding a bit of a supply issue across the board in London, so we're very much drilling down all the way into specific streets, even specific houses on specific streets. With some clients, they specifically want a detached house with off-street parking, for example, and they aren't always that hard to come by depending on the areas that you're looking. So you have to target specific houses on specific streets.
And might you then have to be proactive to actually go out and approach, if there's really nothing coming on and you've narrowed down your search to streets, the client's really keen to do something, how often does it come down to actually making approaches of existing owners?
At the moment, quite a lot, actually. It's being very proactive, it's pounding the pavement, so to speak, to engage with vendors who have previously been on the market, but to source these off-market properties. And that's very much the value add from our point of view, is once we've got to that point, really showing clients that we will go that extra mile to find them the exact property that they're looking to purchase.
Is a premium being placed at the moment on outdoor space? I mean, we've been through this extraordinary period with COVID where certain features of property become more important. Have you seen that coming through in certain areas becoming more popular because of the housing stock they have?
Very much.
Yeah.
Areas like St John's Wood, Primrose Hill, Belsize Park, if we're looking at that kind of northwesterly portion of London, there are more houses with larger gardens, more outside space, and there's very much a premium on that. It was a knee-jerk reaction from COVID, but I think it's very much going to continue. And when the flat market and central London flat market comes back, which we are starting to see now, outside space, whether it's a roof terrace or a balcony, is still going to be very, very important to people buying.
Okay, thanks. And David, I mean, what are some of the issues that buyers like Mr. Sharma might encounter in the London property market?
Well, as Angus was saying, supply is probably the biggest issue at the moment. I think a lot of buyers are just not confident enough to put it out on the open market. So it's literally sourcing the stock, which can be quite an issue. And with stock being so low, we're seeing the agents tending to overvalue. So in some cases, we've seen overvaluations up to about 20%. So these overseas buyers generally come in with a certain budget in mind and a certain expectation. And sometimes there's quite a compromise because London is expensive, and it's soon they'll realise for that budget they might have to compromise in terms of beds or space or even location.
And if a client is engaging you to make an acquisition, how do they pay you a fee up front? How does the fee structure work on an acquisition basis?
There's a small commitment at the start,
right,
which is important. And then, we are retained to source this property for them. But I think it's very important to highlight that because in some cases properties are overvalued, you can buy wrong, and for our small fee, you could be spending a lot more on purchasing a property directly if you bought wrong. So I think it is quite important to make sure that you highlight the flaws per se, and our fee is probably well worth paying.
I mean, Angus, do you find that overseas buyers are used to engaging buying agents because they recognise London market is complex, and that to have someone on the ground there advising and also helping them transact is a strong value add? Yeah,
I think it's become more and more kind of apparent and the norm for buyers coming into the market over the last kind of 3 to 5 years maybe. I think there was a perception that if you were using a buying agent or a property finder that your budget must be huge, 10 plus million, but we've really seen that come down where we're acting for clients in and around the kind of £1.5 to £2 million space. And what we're finding is that, as David said, it's that hand holding, it's doing that due diligence on the ground that they may not be able to do whilst overseas. They may not yet be here in London with their family. So it's doing that on their behalf and acting in their best interests. I mean, do you find that overseas buyers are treated with a level of service in the UK, or they, in actually terms of getting these transactions done, they can be a bit neglected because they're overseas? There's a bit more complexity. Yeah. It's easier to maybe deal with someone on your doorstep.
I think it is. It can be a bit of a minefield for an overseas buyer. I mean, London's so vast. So even each borough has a different form of lifestyle to a certain degree. So, I think it's very important to provide the reassurance. So obviously we're dealing with property transactions all day long. And if we do, on these various property tours, notice a property that they are very suitable to them for their budget, I think they need to get that reassurance from us, and we give them a little bit of a nudge to say, you're buying well, this is a good property. And I think that's quite comforting for the buyer.
Okay, thanks. And Angus, I mean, in summary, how would INHOUS help Mr. Sharma conclude a successful transaction quickly? What things does he need ready and be ready to commit, and what would you offer on the other side to make sure the process is seamless?
I think it's from our point of view, before we get to that point of offering, we want to make sure that our clients, and in this case Mr. Sharma, has all his ducks in a row. So that's very important for us, and especially in a competitive market that we're in at the moment. making sure that we have everything in terms of if there's a cash buyer, we have proof of funds, source of funds, or if they're using finance, we have proof of their financing from their bank, making sure they've engaged with a good solicitor. We're having to offer quite short time frames for exchange and completion to put ourselves and our clients in the best position to get the property and for the vendor to accept their offer. So getting all the ducks in a row before we get to that point is key. From our point of view, we ensuring that we've done as much due diligence on that property that we're offering on for them, so that, as David said, they have full reassurance and commitment that everything has been looked at. And from that, we are previewing on their behalf before they come to London, taking them on the viewing tours, and really holding their hand throughout the whole process.
Okay, thanks. And on the financing side, this is an integral component of this kind of in this kind of case. Perhaps you could give us a sense of what kind of mortgage options Mr. Sharma would have if he did decide. Angus has found him the dream property in St John's Wood, a £4 million property, for example. And if he was remaining resident in Dubai, what are some of the options he might have for the mortgage product?
Sure, David. So as you know, at Barclays Private Bank, we essentially deal with clients with a large aspect of international wealth and international backgrounds. So if Mr. Sharma was looking to buy a UK property, essentially we would provide a mortgage to him, but it would depend on the structure which he's using, whether it's personal name or a company name, which I'm sure Hetal can provide some advice around the structuring. But at Barclays Private Bank, typically at the £3 to £5 million level, we can offer both a regulated or unregulated mortgage, and we could lend up to 70 to 75% loan to value. And of course, we would take his international assets and income streams into consideration when assessing our affordability, given we're dealing with the private bank arm of Barclays.
It is common to use debt in this way because the cost of debt is low, isn't it, on historic levels? So do you see often clients with using debt available to them in this way to make these kind of acquisitions? It's a common scenario.
Absolutely, David. And I think, again, obviously, as a bank, we don't provide tax and legal advice. But again, working with Mr. Sharma's tax advisors, I'm sure that they will understand the benefits of estate planning as well because of the inheritance tax consequences linked to UK real estate. So debt is a common theme used. Obviously, interest rates are relatively low, and it makes the cash flows stack up in that sense.
And would he have options around interest only and repayment? I suppose the different products would depend on the structure that is selected.
So we're very flexible. So we can offer mortgages on an interest-only basis. We can offer amortization options depending on the client's preference, needs, and requirements. We also offer fixed-rate products as well as tracker or variable rate products, which are typically linked over base rate. So, our private bank, we kind of bespoke our offering to the client's needs and requirements. So we would work with Mr. Sharma and family to see what works for them.
Okay, thank you. And, we haven't provided details here in this case of their broader asset base, but I imagine that it's common to have, if clients have portfolios of assets, that they are available for collateral if that's part of security for the debt.
Yeah, so I think typically we take comfort with taking a first legal charge over the property in itself, and we look to understand how the client would service the loan, and obviously given the regulatory environment we're bound by, we have to look at that on a stress basis. But we can obviously look at the international income and asset base to meet serviceability or affordability needs. So again, happy to work with the client if need be. Of course, we do have a separate product for portfolio-backed lending or securities-backed lending. Again, that's something we're very competitive with, and depending on the underlying assets, we could lend on them as well. And obviously, the LTV in this case would vary depending on what the actual financial asset is held.
Okay, terrific. And if it was Mr. Sharma's daughter who was acquiring the property, how would that affect the debt position in terms of what would be available?
So I think there are two parts to this answer for me. At the moment, as I understand, she's a minor, so it's not an option to really lend to her. But assuming 1 year down the line when she turns 18, we could consider lending to her. However, we would have to assess her financial position because ultimately, even though we have a first legal charge on the property, Mr. Sharma's daughter will need to be a borrower to the loan and be able to afford the interest payments on a stress basis. But we have seen in a number of cases for other clients where they typically, wealth passes down from generation to generation. So she may well have some financial assets or some income streams which we could use to lend to her. Sometimes she could buy the property, but the parents may come as guarantors on the loan or joint borrowers. Again, it's kind of dictated by the tax and legal side of their structuring.
Okay, thanks. And if they were deciding to buy a property where they could let out rooms within the house and it was within the daughter's name, how would that affect the mortgage options that are available if it's effectively going to be a rental property, generate some income?
Sure. If they were looking to let the property out, here at Barclays, we offer both residential owner-occupied mortgage solutions as well as residential investment and buy-to-let mortgage solutions. So we could absolutely look to lend against it as long as there's a standard assured short-term tenancy agreement in place. And of course, the structure, again, of how they purchase it, whether it's personal name or through an SPV or trust, will kind of dictate the level of loan to value the bank can offer. But we are flexible based on structure. It just depends on the cash flow yielding from the property as well as the financial strength of the borrower to dictate the level of loan to value in this case.
Thank you. Very clear. Lots of options to consider. And if Mr. Sharma were to decide to move the family to the UK, their wealth management needs would come into the picture and have to be considered. Lots of complexity there. I mean, how would you help the client work out his wealth management and banking needs should he become UK resident?
Sure. David, that's a very valid question. We've seen a lot of families relocate from various parts of the world to the UK. I think to begin with, the most attractive element of the UK for these ultra-high net worth families is the remittance basis of taxation or becoming non-domiciles. And typically, as a bank, we would work with their tax advisors to set up the banking needs to cater to their clean capital planning. So we do offer those solutions out of our various offshore booking centers, be it Crown dependencies or Switzerland. But again, we would work with their tax advisor or look to introduce them to somebody with a background who can help with the pre-arrival requirements. And absolutely, as a bank, we could offer both mortgages in case they want to buy properties, can offer banking requirements, as well as helping, as I said, set up their capital and income split accounts or their capital with gains accounts. We do have a wealth advisory arm or wealth structuring arm, which essentially has a range of people from tax and legal backgrounds, but they do not offer tax or legal advice, but they work with the likes of Hetal to ensure that bankers like myself implement the account structuring in the correct manner.
So you try and work out with them how much money they might need in the UK and then how much is available for investment tax efficiently alongside working on the advice of other professionals who are looking at the big picture.
Sure. So absolutely, we kind of sit down and plan with the family in their family office along with their various advisors to implement the correct banking in place. And we work by the limits set by the advisors in these scenarios. So more than happy to help clients in this position.
And on the investment side, do you find that clients with businesses in emerging markets, are there any trends as to how the clients you deal with set up to invest and construct portfolios?
Yeah, so David, to take that, it's a mixed bag. It varies client to client and it's fairly bespoke. But what we tend to do is educate clients on the need for diversification. And we typically run something with most of our clients, a core and satellite approach. So we have a core portfolio, which is a well-diversified portfolio across various asset classes, sectors, and geographies. And then we have a satellite approach, which caters maybe to the particular requirements. So for example, if we have a client who has a healthcare focus, they may just want a portfolio which they understand, which they can take the decisions on, which they can relate to. But typically the core portfolio would focus on the diversification, whereas the satellite portfolio would be more thematic-based ideas. So absolutely work with clients in the asset management space, provide the necessary investment advice and solutions to help clients with their financial planning needs.
So Hetal, just to bring you in, I mean, we heard from Shamonie there some of the complexities or thoughts that clients have when they're thinking about a property purchase or moving to the UK. But specifically, what are the tax consequences of the property purchase in London?
Thank you. The key tax considerations when thinking about property purchase in the UK, I think the immediate one that comes to mind, and is obviously one that a lot of people focus on, is actually stamp duty land tax. Now, SDLT has changed quite significantly in the last few years. We have a sliding scale from 0 to 12%, but non-resident families are now subject to a 2% surcharge. And in addition to that, if you have another residential property, you'd be subject to an additional 3% surcharge. So it can become quite expensive, and it can be something to really think about and plan who is actually purchasing the property. So in this case, if Mr. Sharma's daughter were to purchase the property instead, and this was potentially her first property, then she would be able to avoid perhaps the 3% surcharge. And in addition to that, if she was residing in the UK and also UK resident, then she wouldn't be subject to the 2% surcharge. It's important to note that the concept of non-residency is different for SDLT. It differs to that of non-residency for the purposes of income tax and capital gains tax, which is governed by the statutory residence tax, and we'll be talking about in a little bit. A few other things that come to mind from an SDLT perspective: we've seen quite a few people be able to benefit from some of the reliefs that are available, so it's worth asking the question. So things where you have an annex attached to the property, or for instance, you're buying a number of properties or number of dwellings together, where you may qualify for multiple dwellings relief. Also, interestingly, if there is any commercial element to the property and it's a mixed-use property, then you would benefit from lower SDLT rates. Income tax is the second tax that I'll talk about. Broadly, not important in this situation unless the property is subsequently let at some point, at which point there would be income tax on the rental income. CGT is capital gains tax. It's essentially a tax on the profit on disposal of any residential property in the UK. Now, something to think about in this situation is where the individual is going to be residing in that property and it will be their main residence, they may qualify for principal residence relief. And again, that's where we might want to think about Mr. Sharma's daughter purchasing the property as opposed to Mr. Sharma if he may not use this as his main residence. In terms of those structures that might be used to purchase the property, if a corporate was purchasing the property, it would also be subject to a non-resident corporate, non-resident capital gains tax, but that has changed format into corporation tax now. Important to note now that the filing and payment of only capital gains tax is within 60 days of completion, so it does bring forward the tax charge. Inheritance tax is probably the most relevant tax that we think about when property purchases happen in the UK, and that's because irrespective of residence or domicile, if you own a UK residential property, there will be exposure to UK inheritance tax typically. Inheritance tax in the UK is at 40%, and it's therefore one of the taxes that most people want to think about in the most detail. Things that we think about with families when managing exposure to inheritance tax is very much now centred around shared ownership or debt. Now, Shamonie would be able to think about the debt options and how they would be applicable here. Typically, debt, given it is fairly cheap in the UK, is a good option, and we just need to be mindful of structuring the debt as an encumbrance to the property in order to make sure that it is deductible for the purposes of inheritance tax. Shared ownership is something that's also coming up more and more. And in this situation, Mr. Sharma might be able to purchase property with his daughter. And what that does is it really shifts some value of the property down a generation, thereby limiting the exposure at the older generation's level, where there may be some higher IHT risk. Typically and historically, a lot of UK residential properties were purchased through non-UK resident companies and trust structures, the benefits of which have really been eroded down since 2017, 2018, when we had significant changes to the way in which UK residential property is taxable in the UK. So principally now, personal ownership is preferred, and in particular, we have another tax called the Annual Tax on Envelope Dwellings, ATED, and this means that if you did own a property through a corporate structure, but like this situation, Mr. Sharma's daughter wants to reside in the property, then there would be an annual tax for the privilege, essentially, of having that property and having access to it. Now, for this property purchase, if we're looking at something above 2 million, the value of, or the charge would be starting at sort of 25,200 per annum. And if it went, or the property purchase was at a value above 5 million, or the value over time increased, then that could go up as high as just under 60,000 at 58,000 pounds as an annual charge. So it's quite onerous on the taxpayer, and one might really want to consider whether or not the corporate structure makes sense. There are some reliefs available. So for instance, if in the future the property was going to be let commercially, then you would have relief from ATED. But given this situation, it strikes me that personal ownership is going to be a better option. Taking those sort of various heads of taxation into consideration, I would say that we really want to consider perhaps gifting the funds overseas to the daughter, and the daughter subsequently purchasing the property. It's not one answer fits all, but it strikes me that if we move the value down a generation, benefit from the fact that if she were to subsequently dispose of the property, she may qualify for principal residence relief and qualify for perhaps lower rates of SDRT, that might be a good option for her.
Thank you for that. Could you perhaps set out the residency rules that will be relevant for Mr. Sharma?
So in terms of tax residency for Mr. Sharma, he may find that he's spending more time in the UK with the family and with his daughter coming to study in the UK. Now, on the basis that he doesn't commence UK employment or spend more than 183 days in the UK, we'll assume that he won't trigger automatic tax residency in the UK. I'll also assume that he's not automatically non-UK resident by virtue of the fact that he's spending more time in the UK. So from 2013, the UK introduced the Statutory residence test, and this provided some very clear guidelines as to how an individual triggers tax residency in the UK. And it's quite prescriptive, which means that one can plan around it and within the remit of it. For Mr. Sharma, he would be treated as an arriver under the sufficient ties test. And what this means is that he's not been tax resident for any of the prior 3 tax years. As a result, what we look at are the ties that he has to the UK or will have to the UK in that tax year. The first tie that he may trigger is the accommodation time. So this is where an individual has access to a property for over 91 days, and that's 91 continuous days, and stays in that property for at least 1 night. If they meet that criteria, then they would trigger an accommodation time. Interestingly, even if he didn't own the property, but it was the property of a close relative, and he spent more than 16 nights there, he'd equally trigger the accommodation time. Another one to be mindful of for him will be the work tie. And given this era of working from home and digital working, one might find that this is more easily triggered than anticipated. So a work tie is triggered when an individual works for more than 3 hours on at least 40 days in the UK. In terms of sort of how to manage this, we've put a lot of emphasis on diary management and keeping good records. So if it were inquired into by HMRC, then that's something that we would be able to help an individual defend. Another tie that may be triggered for Mr. Sharma would be the family tie. Now, a family tie would be triggered for him if his spouse or minor child trigger tax residency in the UK of their own accord. Now, where I see this being possible and where we see this in practice quite frequently is if the younger children subsequently joined boarding schools or started school in the UK. And the way to sort of navigate this one is where we think about keeping really good records about day counts in the UK, but also non-term time in the UK, as there is an exemption for minor children being treated as residents for the purposes of this tie, where the non-term time spent with the parents is reduced. The last tie to consider for an arrival would be the presence tie, and that's quite easily triggered. So anyone spending more than 90 days in either of the prior 2 tax years will have a presence tie for the following 2 tax years. So if we apply this to Mr. Sharma, it strikes me that at the outset he would trigger 1 tie, which would be the accommodation tie, and therefore he could spend up to 182 days in the UK without triggering tax residency. However, we have to be mindful that he will have triggered a presence tie for the following tax year, and that means that he would have 2 ties and be able to only spend 120 days before triggering tax residency. Now, for argument's sake, if he did trigger either the work tie or the family tie in that first year, so he would only be able to spend 120 days, and in the same way, he will have triggered a presence tie for the following year, and therefore only be able to spend 90 days in the UK for the following years. And that's something we really do plan with our families. And it's a case of sometimes it's as prescriptive as 120 days in year 1, 90 days, 90 days, and then thinking about dropping it below 90 days so that you don't have a presence tie for a following year. It strikes me that typically for him, he probably will be able to spend up to approximately 3 months, so approximately 90 days in perpetuity without triggering tax residency if he's got good advice in place and sort of navigating his work and family links. Important to note, though, that if he did trigger tax residency for 1 year, then he would no longer have the same day counts to consider. The day counts would be different, as he would be treated as a leaver, as he had been resident for 1 of the prior 3 tax years. And broadly what this means is that he'd be able to spend fewer days in the UK with the same number of ties.
And what impact would it have on Mr. Sharma's affairs if he did become UK tax resident?
If Mr. Sharma did trigger tax residency in the UK, then as a starting point, an individual is subject to worldwide taxation on the arising basis when resident in the UK. For Mr. Sharma in particular, what we would want to think about and start talking about is the fact that he's likely got a non-UK domicile. And what that means is that he is not originally from the UK and hopefully has a domicile of origin outside of the UK and arrives into the UK not acquiring a domicile of choice in the UK. A domicile of choice is the intention to reside either permanently or indefinitely in the UK. So if he is not UK domiciled, he would be able to benefit from accessing the remittance basis of taxation. Now, what is the remittance basis? The remittance basis is a basis of taxation which is fairly advantageous, and it essentially means that you're only taxable on your UK source income and gains, and those foreign income and gains that you remit, and that means transfer to the UK. For the first 7 years of tax residency in the UK, that's a benefit or an access to a taxing regime that's free. But after 7 years of tax residency, there would be an annual charge of £30,000 a year, which is referred to as the remittance basis charge. And after 12 tax years of residency, that would increase to £60,000 a year. After an individual's been resident for 15 tax years, they would become deemed domiciled in the UK. And that would be for all tax purposes. So that's income tax, capital gains tax, and inheritance tax. Therefore, if we were working with Mr. Sharma, what we would be looking to think about is pre-arrival planning. And essentially, that's where we think about what sort of access to funds he might require in the UK to fund his lifestyle in the UK. The reason for doing that is that if an individual does create clean capital, and clean capital is essentially funds that haven't been tainted with foreign income and gains, then those funds can be remitted to the UK to fund lifestyle, to help with the property acquisition, for instance, free of any further taxation. So it's very much worthwhile thinking about creating clean capital, thinking about the sort of medium to longer term requirements in the UK. Another thing to think about in this instance would be account segregation. So where an individual creates that clean capital, it's really important that once they're tax resident in the UK, that income and gains from any investments are also segregated. And there are a number of structures that we can help Mr. Sharma create with the help of their banking partners to put in place. In terms of pre-arrival planning, we also talk about rebasing assets, and that's with a view to really creating a lower tax margin in the UK if they were to subsequently dispose of assets once resident. One thing to also bear in mind is that if the individual is claimed on a remittance basis, or if they are paying tax on the arising basis, they may also be dual resident and tax resident somewhere else. As a result, we would also take into consideration any tax treaty provisions that are applicable to them. So it may transpire that Mr. Sharma is actually treaty resident in Dubai, for argument's sake. And this will mean that there will be different principal taxing rights depending on the type of income and gains that are triggered.
And on the immigration side, what about the visa status of his daughter?
So Mr. Sharma's daughter will presumably have come to the UK on a student visa. And important to say, I'm not an immigration advisor at all, but my colleagues would be better placed to help with this. But broadly, a student visa means that they will have some working rights in the UK. And after they finish, they would need to make a separate application for the graduate visa, which would give them access to working in the UK or studying or travelling in the UK, but staying in the UK for 2 years after they graduate. That 2 years would often be seen as a window for them to try and switch onto a skilled worker visa if they're able to secure UK employment. Or if they start up their own business, then a startup or innovator visa.
And finally, how about access to the UK for the rest of the family and their visa requirements?
So for Mr. Sharma and the wider family, typically the options are limited to the investor visa or the sole representative visa. The investor visa requires a commitment of £2 million to be invested into the UK. And it strikes me that because Mr. Sharma has already relocated to Dubai and has assets outside of India, he won't be restricted by the same capital restraints that some Indian resident families are restricted to. But it's worth bearing in mind that we do often find that the investor visa doesn't quite work for those Indian resident families. And therefore, we have considered and used the sole representative visa for some families. This works particularly well if a family has flexibility over the corporate entities that they're involved in. And that's particularly important because they, and by they I mean Mr. and Mrs. Sharma, couldn't be the majority shareholders of the entity that's setting up the sole representative office in the UK. So it works quite nicely for family office clients. And we've had some good success with that. But typically the most popular route tends to be the investor visa.
Thank you, Hetal. So Mr. Sharma's coming to London next week. He wants to come and meet you and see you. What is it that will be the pressing items on the agenda that you'd want to discuss with him? Angus, what would you want to talk to him about?
So I think first and foremost, as we touched on earlier, it's finding out exactly what Mr. Sharma is looking for in terms of the property purchase, what his drivers are, and how him and his family are really looking to use the property and what their lifestyle is. So from that first meeting, that's exactly what we're looking to try and find out. And then from there, we can give them some more information on the property market as a whole before we then drill down into specific properties, price points and areas in order to then find them the perfect property.
David, in that first meeting with Mr. Sharma, what is it that you'd want to discuss with him, impress upon him, and start off the conversation with?
Yeah, I think it's very important that part of getting to know that individual is what other professional bodies we can introduce them to, such as Shamonie at Barclays or Hetal at Edwin Co. Because they do have to get their ducks in a row, especially when it comes to the tail end of the purchase when we're actually offering on properties.
So Shamonie, Mr. Sharma coming to London next week, you'd like to have a coffee with you and discuss. What are the things that you would be raising in that first meeting as things that he should consider of great importance?
Yeah, the main things I would like to kind of meet him, understand more about him, his requirements, what he's looking to achieve out of the UK, what the family's plans are long term, and of course, I explained to him about Barclays, its history being a British bank for over 330 years, and explain the offering. It's a holistic offering which can cater from banking to investments to mortgages, whatever his needs are. So just let him know that we're here as partners to help him grow whatever his requirements are in the UK. So main thing, David summarizes, what is Mr. Sharma looking to achieve in the UK? What are his family plans? And set up a roadmap to see how Barclays can be his trusted financial partner in the UK.
And Hetal, over to you. Mr. Sharma's booked in to come and see you in Lincoln's Inn Fields at Edwin Co. What is it that you'd be have on the agenda to discuss with him?
So if Mr. Sharma was coming to meet with us, we would really want to think about a few things as the pressing issues. And one of those would be really thinking about day counts. And that's how much time does he think in a tax year? And a tax year in the UK is 6th of April to the following 5th of April, the day counts that he thinks he'll spend in the UK. And that tends to be the guiding or the driving factor as to what will be a viable option for him and when he might trigger tax residency. Really important to note here that we have seen a number of families where an individual is travelling to the UK simply on a tourist visa, which gives them access to travel for 6 months, but actually inadvertently triggering tax residency because it's not realised that actually the immigration point and the tax residency point are looked at completely separately. Aside from the day counts, I'd also recommend thinking about and giving some consideration to requirements to cash, and that's funds in the UK for the family. So thinking about the university fees, thinking about the property acquisition, thinking about lifestyle funding for the wider family, because that might drive the discussions around how much clean capital a family actually wants to create, because there is quite a limited opportunity from Mr. Sharma's perspective to really create that clean capital. Finally, I'll also give some consideration to how comfortable Mr. Sharma feels passing on the wealth to his daughter and whether or not he wants to have involvement in the property ownership in the UK. And further on from that, giving some consideration to also putting wills in place for the UK, because that will be important now that they're going to acquire quite a substantial asset in the UK.
Thanks very much.